Full reserve banking, the system that solves almost every banking problem. Want to stop banks suddenly collapsing? Want to stop bank bailouts and bank subsidies that cost taxpayers billions? Want to stop credit crunches and the long dole queues that result from credit crunches? Well, there's a simple way of doing all that. Just dispose of the fraudulent element in our banking system. Fraudulent? Yes, fraudulent. As Martin Wolf, chief economics commentator at the Financial Times, put it, if we are not so familiar with banking, we would surely treat it as fraudulent. So where's the fraud? Well, it's like this. First, banks accept deposits from people like you. Second, they lend the money on, for example, for mortgages and to businesses. Third, banks promise to return to depositors the exact sum deposited, maybe plus interest and maybe minus some bank charges. Spotted something wrong there? No? Not spotted the fraud? Well, it's simple. There's a very good chance that during the life of any bank it will make a series of silly loans, or it will have bad luck with its loans, at which point it won't be able to repay depositors all their money. So that promise made by banks is the same as you taking money off your friends for safekeeping, then investing the money on the stock exchange, and when the investments fall in value, telling your friends they can't have their money back. That's fraud. Of course, you could argue that the actual chance of a bank going bust in any 1 year is just 1 in 50 or thereabouts, so there's not too much fraud there. Well, sorry, but a promise to repay X pounds is a promise to repay X pounds, period. In contrast to the above fraud, if you agreed with your friends that their money was to be put at risk, and you all agreed to share profits and losses, that would be open and above board. That would be fraud-free. It would be honest. Likewise, in the case of banks, where depositors want their money to be loaned on so that they can earn interest, and they agree to bear the losses when they occur, that would also be fraud-free. It would be honest. But that's not to say that depositors should be exposed to any old risk chosen by their bank, which is more or less what happens under the existing system. i.e. banks can use grandma's savings to bet on dodgy derivatives. Far from it. If depositors or stakeholders are to be exposed to risks, they have the right to specify what sort of risk they want to be exposed to, including the option of being exposed to no risk at all. So under the new system, banks will be forced to offer depositors a range of options as to what is done with depositors' money. Depositors could opt for 100% safety, in which case the bank would simply warehouse or store the money in a 100% safe manner, i.e. not lend on or invest the money. The money could be lodged at the central bank, for example, but that would mean the money earning no interest. Incidentally, money held by commercial banks at the central bank is often called reserves. Hence the name full reserve banking is often applied to a bank whose assets consist just of those reserves. Anyway, getting back to the options that depositors have under full reserve, in addition to 100% safe accounts, depositors will be free to choose something more risky, offered by the not 100% safe half of the banking industry. That could be something 99.9% safe, e.g. funding mortgages where house owners had a minimum equity stake of, say, 20%, or depositors could opt to fund riskier 100% mortgages, or for that matter, dodgy South American gold mines. But in each case, depositors would foot the entire bill if things go wrong, and they share in the profits if all went well. Incidentally, that system has similarities to Islamic banking in that lenders share in the profits and losses made by those they have lent to, though this video does not support all the elements of Islamic banking. To summarise so far, under full reserve, the existing banking industry is split into two halves. Safe half. Money is lodged at the central bank, so it's 100% safe, so that half of the former banking industry cannot suddenly go bust. The money is instant access, but little or no interest is earned. Lending investment half. Money is loaned on or invested, but depositors essentially buy a stake or share in those investments or loans. Hence, this half of the industry is really no different to existing unit trusts, that's mutual funds in the US. This half cannot go bust because, as with existing unit trusts, if poor loans or investments are made, all that happens is that the value of the units falls. As to how to split between 100% safe accounts and what might be called investment accounts is organised, there are different ways of doing that. For example, Milton Friedman favoured one lot of organisations or banks offering safe accounts and another lot offering investment accounts. But others think that the two options could be offered by the same organisation, i.e. under one roof. But that's a minor point which is not examined further here. And that's it. Those simple rules dispose of most of our banking problems. On the subject of the impossibility of the investment half of the industry failing, George Selgin said something about that in his book on banking. As he put it, for a balance sheet without debt liabilities, insolvency is ruled out. Incidentally, that's not to suggest that Selgin or any other person or organisation mentioned in this video agrees with this video. Moreover, in addition to there being no problem when one particular bank does badly, the problems arising when the entire banking sector does badly under full reserve are also reduced, as implied by Mervyn King, former governor of the Bank of England, when he said, "We saw in 1987 and again in the early 2000s that a sharp fall in equity values did not cause the same damage as did the banking crisis. Equity markets provide a natural safety valve. When they suffer sharp falls, economic policy can respond." But when the banking system failed in September 2008, not even massive injections of both liquidity and capital by the state could prevent a devastating collapse of confidence and output around the world. End of quote. The above simple rules also dispose of the billions of dollars worth of subsidies that banks get. That's because the only reason that taxpayers stand behind private banks, i.e. subsidise them, is that those banks are inherently fragile, as pointed out above. The value of the loans they've made can fall below the value of deposits and bonds that fund those loans, at which point the bank is likely to be insolvent. But if we make it impossible for banks to suddenly go insolvent, then no bank subsidies are needed. Garages and restaurants aren't subsidised, so why should we subsidise banks? Of course, any business should be allowed to decline slowly, but it's the sudden failure of banks that's the problem. Objections to full reserve. Now, you've probably got a few objections to full reserve banking. Well, rest assured, advocates of that system have answers for all the so-called problems. So let's run through the so-called problems. So-called problem number one. Haven't banking problems been sorted out recently thanks to improved bank regulations introduced, for example, by Dodd-Frank rules in the US or the Vickers Commission in the UK? Well, laugh out loud. Those recent attempts to improve bank regulation are a farce. Numerous authorities, including Gordon Brown, Britain's former Prime Minister, and Alistair Darling, Britain's former Finance Minister, have said that the new bank regulations are near useless. There's a list of literature at the end of this video, authored by Brown, Darling and others, explaining why the new regulations are defective. So-called problem number two. With banks no longer being subsidised, banks would have to charge more. For example, they'd raise interest rates for borrowers and firms wanting to invest, and that would hit economic growth. Well, there are several answers to that. First, it's a cardinal rule in economics that GDP is maximised when the price of goods and services is at free market prices, unless it can be shown that the free market has gone seriously wrong in some way. But in this case, what reason is there for thinking there's anything wrong with the free market interest rate? Hard to think of any reason, isn't it? In other words, a reasonable assumption is that GDP is maximised when we do not interfere with the rate of interest, e.g. by subsidising banks. Second, the interest rate rise would not be astronomical, and for the simple reason that bank subsidies, unjustified as they are a smallish percentage of banks' turnover, perhaps roughly 5%. So on that basis, if the rate for a typical mortgage is 6%, then that would rise to 6.3%. That's 6 times 1.05. But even if the rise was substantially more, remember that interest rates were way above present levels in the late 1970s and early 80s. The typical interest rate on a mortgage in the UK at that time was over 10% and reached a peak of about 15%. That's about 3 times the typical level in 2014. But economic growth was perfectly respectable in the 1980s. In fact, it was far better than during the 5-year-long recession, which began around 2007, and during which interest rates have been at record lows. The reality is that given a big rise in interest rates, households and firms are very flexible. Given time, they simply adjust to the new reality, e.g. by borrowing less. Third, any loss for borrowers when interest rates rise is a gain for savers. So to that extent, there are no overall gains or losses. Fourth, most countries already have systems for helping first-time buyers and less well-off owner-occupiers. So thus, if any interest rates rises were seen as excessive, most countries would not need to implement any new systems to deal with that problem. They just make adjustments to the above existing systems. Fifth, you might think that in view of the risks run by shareholders, they demand a higher return than depositors. Thus interest charged to borrowers would rise substantially. Well, doubtless interest rates for borrowers would rise in that subsidies for banks are removed. But apart from that, there's a good reason to think that the rise in interest rates would be small, and that's the fact that the return on equity in stock exchange quoted corporations over the last 50 years or so has been little different to the return on 100% safe investments, like government debt. Sixth, everyone nowadays complains about the high levels of private debt. Well, if we subsidise banks, then those debts are bound to be on the high side. Plus, we'll get a larger banking industry than would exist without any subsidies. After all, banks are in the business of lending, that is, creating debt. In fact, the UK banking industry is now 10 times as large relative to national income as compared to the 1960s. And what do we gain from a bloated banking industry and private debts that are now larger than ever? As Adair Turner put it, much of what banks do is socially useless. Plus, economic growth was perfectly respectable in the 1960s, so it's nonsense to argue that a lot of bank lending is needed to bring decent economic growth. So-called problem number 3. If this new system is so wonderful, why hasn't anyone thought of it before? Well, they have. Numerous leading economists have advocated this system before and are advocating it today. Milton Friedman advocated this system in the 1960s, as did Irving Fisher in the 1930s, and 2 of the many present-day economists advocating the idea are Lawrence Kotlikoff, economics professor in Boston, and Richard Werner, economics professor in Southampton in the UK. So-called problem number 4. If this new system is so wonderful, why didn't Friedman, Fisher and so on manage to get the new system implemented? Well, corruption has a lot to do with it. Remember that full reserve does away with bank subsidies, and everyone, including bankers, like being subsidised. Plus bankers offer very big sweeteners to politicians to ensure that bank subsidies stay in place. Or as Senator Dick Durbin put it on the subject of corruption, and the banks are still the most powerful lobby on Capitol Hill, and frankly they own the place. Or as Milton Friedman put it in the book On the Right, and on the question as to why the system he favoured would be hard to implement, the vested political interests opposing it are too strong, and the citizens who would benefit both as taxpayers and as participants in economic activity are too unaware of its benefits and too disorganised to have any influence. So-called problem number 5. Money in safe accounts is not being used, which is a waste of resources. That is, that money is not being loaned on and invested. Incidentally, that objection was raised by the UK's Independent Commission on Banking, chaired by Sir John Vickers. Well, the simple answer to that is that if the average person suddenly decided they wanted to keep 1,000 in £10 notes under their mattress, it would cost almost nothing to grant them their wish. Printing £10 notes costs almost nothing. And the same goes for digital money, which is the form that most money takes nowadays. Put another way, contrary to the above objection, money in paper or digital form is not a real resource. It's simply a token. So-called problem number 6. There be complaints from the population about their inability to earn interest on deposits while enjoying 100% safety. Answer. The indisputable fact is that if money earns interest, then that money is being loaned on or invested, and that means the money is being put at some sort of risk. Now someone somewhere must carry that risk. Why shouldn't the person who profits when the risk pays off also pay a price when the risk goes wrong? Anyone refusing to carry that risk is simply trying to have their cake and eat it. And if they refuse to carry the risk, then the taxpayer carries the risk. And that means the banking industry is being subsidised, and subsidies do not make economic sense. So the idea that anyone is entitled to interest on their money while being excused having to carry risk is plain false logic. It's just self-deception. Certainly there could be political difficulties in introducing full reserve banking, but it would have been politically difficult to stop lions eating Christians in ancient Rome. Slavery was only abolished after a long drawn-out battle, and arguably still hasn't been abolished. That doesn't prove that having lions eat Christians or slavery are acceptable, does it? If something is unacceptable, then we've just got to start removing it. That might take a generation, but the fact that bad practice is difficult to remove is not an argument against trying to remove it in the long run. So-called problem number 7. Existing bank capital ratios of roughly 5% are no doubt too low, and no doubt Martin Wolf and others who advocate raising that to about 25% are right to say that 25% or so would make banks 99% safe. So what's the point in raising the ratio to 100%? That's the capital ratio. Isn't that just overkill? Well, the answer is that even at a 99% safety level, governments would still feel impelled to guarantee deposits, and depositors will probably still demand such guarantees, i.e. governments and depositors in the latter scenario are still asking for banks to be subsidised, and subsidies, to repeat, do not make economic sense. You could, of course, impose, say, a 50% capital ratio, and that sort of ratio was common in the 19th century, and then abolish the guarantee. But in that case, depositors stand to lose out if a bank does go bust. Thus those depositors are effectively shareholders. So the ratio is effectively 100%. QED. Fractional reserve banking is in checkmate. It's a logical self-contradiction. A related possible objection is that under full reserve, commercial banks no longer have the same freedom to suddenly increase their loans when particularly worthwhile lending opportunities arise. There are several answers to that. First, the reality is that the main explanation for large increases in lending is banks stoking asset price bubbles. For example, there was a huge rise in expansion in lending in the 3 years or so prior to the downturn in 2007 by UK banks. That's the red line on the right. Compare that to central bank issued money, the blue line, which doesn't rise nearly so fast. In fact, it falls. Second, under full reserve, any lending organisation with its head screwed on will keep a proportion of its funds in reserve so as to be able to jump on any particularly good lending opportunities that arise. So-called problem number 8. Under the versions of full reserve banking advocated by Milton Friedman, Positive Money and others, interest rate adjustments are ruled out. Thus government and central bank lose one of their main weapons for regulating the economy. Well, that's no big problem, and for the following reasons. First, interest rates charged are supposed to influence investment spending. But why implement stimulus just via investment spending? Recessions are not necessarily caused by a drop in investments or investment spending. Second, the evidence, e.g. a recent study done by the Federal Reserve, is that interest rate changes don't influence investment all that much. Third, central bank interest rate changes have no effect on credit card rates. Fourth, in that interest rate adjustments do work, the evidence is that they don't work all that quickly. Fifth, when interest rates are raised, that does withdraw money from the economy, but it also induces foreigners to pile in and take advantage of the new higher interest rates available. So the country ends up paying millions to foreigners. Sixth, as pointed out by Mervyn King, former Governor of the Bank of England, the demand increasing effect of an interest rate cut is temporary. Reason is that interest rate cuts pull investment forward in time, but that pull forward effect is necessarily of limited duration. Seventh, government and central bank can still control the economy by varying government spending and tax, as explained by Milton Friedman, Positive Money and others. So-called problem number 9. The above analysis is based on the idea that banks lend on depositors' money. In fact, commercial banks get the money that they lend from out of thin air. They create it ex nihilo. Well, the answer to that is that private banks engage in both the above activities. For example, prior to the 2007 crash, private banks were certainly creating money out of thin air and lending it out like there's no tomorrow. In contrast, at the height of the crisis, the private bank system was making no net additions to the money supply at all. Indeed, in Irving Fisher's famous debt deflation scenario, the money supply actually contracts. So-called problem number 10. Banks would try to circumvent any new rules. Answers. First, obviously banks try to circumvent rules. Likewise, whatever speed limits are imposed on roads, numerous drivers ignore those speed limits. But that's not an argument for a rule-less free-for-all, is it? Second, one of the main problems with the existing fractional reserve system is the freedom it gives banks to create and lend out money in a boom, which exacerbates the boom. Now, creating money is easy, as Minsky pointed out, but it's a difficult thing for individual people and small organisations to do. To that extent, it wouldn't matter too much if the smaller shadow banks evaded the rules. Third, the rules of full reserve banking are extremely simple compared to the Dodd-Frank rules in the US or the Vickers Commission rules in the UK. Thus, the rules of full reserve are vastly easier and cheaper to enforce than Dodd-Frank or Vickers or the Basel banking rules. And that's about it. The rest of this video is just a summary of the main points and some details, as promised earlier, on the mess that are existing attempts to improve bank regulation as of early 2014. Plus there are some details on some of the books, etc. mentioned earlier. There is no more sound from now on. Thanks for listening and watching.